For most of modern history, inequality was treated like background noise. Unpleasant, occasionally alarming, but ultimately temporary. The belief was simple. If the economy grows, prosperity spreads. If productivity rises, wages follow. If markets are free, fairness eventually emerges. Growth would fix everything. And for a few decades, it looked like it did. But what if that belief was based on a historical illusion? What if the period we thought was normal was actually the exception? Welcome to the Financial Historian, where money, power, and time intersect. This is not a debate about politics. It's not left versus right. It's about what happens when you zoom out far enough. That comforting stories stop surviving the data. For most of the 20th century, economics focused on expansion, output, efficiency, productivity. The logic was straightforward. Make the pie bigger, and everyone's slice grows. After World War II, this seemed undeniable. Across the United States and Europe, inequality fell dramatically. Wages rose in real terms. The middle class expanded. Home ownership became common. Wealth concentration declined. Economists studied this era and quietly assumed, this is what mature capitalism looks like. Stable, upward moving, self-correcting. But that conclusion relied on a dangerously short timeline. Because when you extend the lens beyond a few decades, the pattern changes. Instead of studying 30 years, one economist studied 200. Instead of theory, he started with archives, tax records, estate filings, national accounts, income distributions, across countries, across centuries, and when the numbers were stitched together, the post-war golden age didn't look normal anymore. It looked rare. For most of the 19th century, the era romanticized in literature and industrial optimism. Wealth was overwhelmingly concentrated, not because of merit, not because of innovation, but because of inheritance. Capital ownership dominated economic life. If you owned land, factories, or financial assets, your wealth generated more wealth. If you relied only on labor, your progress was limited by time. The dramatic decline in inequality after 1914 wasn't caused by markets becoming fair. It was caused by destruction. 2 world wars wiped out private fortunes. Inflation eroded asset values. Governments imposed aggressive taxation. Entire financial systems were reset. Equality didn't emerge gradually. It arrived through disruption. And once those disruptions faded, the old patterns slowly returned. That's when the core question emerged. Why does wealth tend to concentrate, even in democratic, market-based societies? Not as a moral accusation, as a mechanical observation. The answer begins with a simple distinction. Labor versus capital. Labor is what you earn through effort. Your salary, your wages, your time exchanged for income. Capital is what you own. Assets that generate returns simply by existing. Property, stocks, businesses, bonds. Labor grows linearly. You negotiate a raise. You improve skills. You work more hours. Capital grows exponentially. It compounds. It reinvests itself. It doesn't need rest. It doesn't age. It doesn't negotiate. And here lies the formula that unsettled the conversation. When the return on capital consistently exceeds the growth rate of the economy, wealth accumulated in the past grows faster than income earned in the present. Or more simply, R greater than G. When returns on assets outpace economic growth, ownership pulls ahead of effort. If you already hold capital, your wealth expands faster than the economy itself. If you depend solely on income, you're trying to catch up to something accelerating away from you. This is not ideology. It's compounding mathematics. Over short periods, it's subtle. Over long periods, it's decisive. History shows this repeatedly in low-growth environments, which mature economies often become. Capital doesn't need explosive innovation to win. It only needs time. And time is the one resource capital always has. This explains modern contradictions. Why housing prices rise faster than wages? Why stock markets surge while median incomes stagnate? Why inheritance is regaining importance? Why asset ownership feels increasingly decisive? When growth slows but returns on assets remain strong, wealth quietly separates from work. And the separation widens gradually, not dramatically, which makes it harder to notice. Critics argue innovation disrupts old wealth. And sometimes it does. New industries create new fortunes. Technology reshapes markets. Mobility exists. But systemic averages overpower individual exceptions. For every new billionaire created by disruption, many existing asset holders quietly compound their advantage. At scale, the arithmetic persists. Zoom into 1 decade, and inequality looks cyclical. Zoom out across 2 centuries, and inequality looks structural. Periods of equality appear historically unusual, and when they occur, they are often linked to shocks. War, crisis, inflation, heavy redistribution, not gentle market adjustments. This reframing forces uncomfortable clarity. Markets are extraordinarily effective at allocating returns to ownership. They are not designed to equalize outcomes over time. Understanding this shifts the conversation. It stops being about blame. It becomes about mechanics. Who benefits when asset prices rise faster than wages? Who captures economic growth? Who is positioned to compound? And who is exposed when growth slows? In a world of slower growth, ownership matters more than ever. Because when expansion weakens, capital doesn't slow proportionally. It keeps earning, and the gap widens quietly. This perspective doesn't dictate policy. It doesn't demand ideology. It simply extends the timeline. And when you extend the timeline, you start seeing patterns that short-term narratives conceal. Wealth has habits, and one of its strongest habits is accumulation. Left uninterrupted, it gathers where it already exists. Interruptions can happen. Systems can change. Policies can reshape incentives. But none of that occurs automatically. Markets do not wake up one morning and decide to be more equal. They compound. And compounding, over decades, reshapes societies. The real insight isn't pessimism. It's realism. If inequality is structural rather than temporary, then financial awareness must go beyond income. It must include ownership. It must include exposure to assets. It must include understanding how time interacts with capital. Because if you mistake a long-term structural force for a short-term fluctuation, you don't just misunderstand history. You misunderstand risk. And in economics, misunderstanding risk is rarely forgiven.